Hi, folks. I'm Mike Zlotnik, Big Mike, and I'm joined here by Diana Boring. Hi, Diana.
Hello.
Thank you for joining. Diana is our manager of investor relations, and today's presentation is going to be all about don't just survive the economic downturn, learn how to thrive. And a wonderful disclaimer, this is for informational educational purposes, no solicitation of any kind, no advice of any kind. If you're interested in our family of funds, request PPM, private placement memorandum, to accredited investors only, consult with your attorney and CPA professional. Just a couple of words about Tempo family of funds. So we've been around in the fund management business since 2009, and we've raised over $150 million in equity capital, deployed both debt and equity investors, with some with leverage, some without. Our business philosophy is investors comes first. We pride ourselves on white glove service, and Diana is here to help you, our investors, with that white glove service. And we diversify. It's one of our key benefits. We spread our capital among many strategies, many locations, many operators. We run family of funds. That's the best way to describe it. And we use third-party administration and audit. We don't touch the books. We don't do anything with the books. All of it gets done by third-party companies as well as third-party auditors. And one of our biggest strengths, we write checks with operators again and again and again. We negotiate the best terms because we're programmatic, systematic investors. We write larger checks. As a result, we get better economics for our funds. And we communicate often through webinars, online Zoom calls, monthly town halls, as well as formal reporting through written reports and investor update calls. Well, investment journey is not always smooth sailing. As much as I prefer the smooth sailing, and most of us do, from time to time we have to experience, unfortunately, a roller coaster ride. And now at the times, we're recording this in mid-June 2023, it's a little bit of a roller coaster journey. Some things are doing well, some things are on the way down, some things are already down. So we'll talk about that, but that is the life of investment. You have to be prepared for the ups and downs and still have the smooth sailing in mind. Just be prepared for this type of environment. And this is a wonderful chart. Diana, thank you for putting it together. This chart is all about real estate market cycles. And there are different market cycles for different real estate assets. So as you can see here, just to mention a few, this retail, hospitality, multifamily, office, self-storage, industrial, residential. There are other asset classes and strategies, but these are the main ones. And the real estate cycle typically has 4 phases. A recovery phase, this is what you have seen, most of us have seen, post-2008 crisis. The recovery happens after typically a recession. After the recovery, we go into economic expansion phase, and that is what we experienced over the last many years. And once you hit the peak of the economic expansion, you go into hypersupply. That's the name of the phase. Not always is it accompanied by hypersupply, but that's the phase where the assets begin to slide down, and then ultimately we experience economic recession. So let's just talk a little bit about a few asset classes and where they are in the cycle. So office in general, most of the big city office is in deep recession, was dislocated by COVID, and it is not easy to see how that asset class will recover. The demand for office has been fundamentally reduced, as many folks prefer to work from home. So a lot of these office buildings will have to be redeveloped into multifamily or something like that. And if you look at the residential, for example, asset class, it's not experiencing yet hypersupply. In fact, the supply is very, very limited. It's sort of at the peak of the expansion phase. Now, some markets have already corrected. So this is a general high-level discussion. Market by market, things are a little different. But residential is not experiencing hypersupply yet, simply because the interest rates are so low, and many property owners just don't want to sell their properties with low mortgage, because if they can't buy a new one with the same rate the way they got a few years ago. So 2/3 of all mortgages out there, sub 4% mortgages, and a lot of owners just don't want to sell. So the supply is very limited as a result of that. Now, if you look at some other asset classes like multifamily, like industrial, self-storage, they are sort of just at the beginning of the hypersupply. They're not yet deep into hypersupply. A few other asset classes are already experiencing a little bit more of hypersupply, such as retail and hospitality. As economy slows down or will continue to slow down, these asset classes typically experience a little bit faster slide. The biggest risk today in this environment is the fact that we can go quickly from an expansion phase into a recession phase without spending much time in hypersupply. That's the biggest concern and risk. And the reason for this is simply that the interest rates have gone up too fast and too furious. And this is driven by the Fed action. We'll talk about that. But commercial real estate sector in general is financed with shorter duration debt, not like residential. And as a result, many assets are doing just fine, but many owners, many operators are distressed because the interest rates have gone up. We'll talk about this in just a few slides.
It's important to note that every area is different. So not all markets are going to be the same or look the same. And so just keep that in mind. Your market might be different than others, but this was a high-level overview of the United States as a whole.
Thank you, Diana. That's an absolutely great comment. The reason for this is all real estate is local. That's the expression. It's all different. Every market is different. So absolutely great commentary. I appreciate that. Risk light is on. That's what has happened. The interest rates in general is a gauge of risk. That's the best way to describe it. So when the interest rates were low, the risk was perceived very low. When the interest rates have gone up a lot in a very short amount of time, the perception of risk shot through the roof. That's the reason that many investors are shying away from equity deals, because you can park the money safely, get the yield, and not take the risk in US Treasuries. So again, asset pricing has become very difficult because the volume transaction has collapsed as a result of this, 75% reduction in the volume from last year. And as a consequence, it's got very hard to determine what is the V in the LTV. So that's one of the major concerns or uncertainties in this environment. And the cost of capital is also uncertain. Interest rates have gone up. What's going to happen from here? Everybody's hoping and praying that the Fed will start easing, but they have continued to sing the song that they're not ready to ease. They still are considering some rate hikes to fight the inflation. So we're dealing in this environment where they should be stopping and should potentially start easing, but they're not saying they will. So a lot of uncertainty in relation to that. Also remember, the Fed action has long and variable lag, simply means that it's a delayed and uncertain impact that may take a long time to realize the ramification of their rate hikes, the fury of that. Is it going to be soft landing, rolling recessions? And when will it start easing? These are all questions we don't know the answer to. What we do know is that it's going to be opportunities to invest in distressed deals in both in equity and debt. And fresh capital will be looking for investing with downside protection and deep discounted deals. That's kind of the name of the game in this phase. So we already got these deals. The next slide will show a deal that we've been able to invest in this environment, even though most people are just thinking, well, it's going to be second half of this year. We'll see some of the deals happening even now, distressed sellers. Here's the deal. So we're pretty excited about this deal. It's the two open-air shopping plazas, one in Fairfax, Virginia, the other one is in Orlando, Florida, with a super high-quality anchor tenants and a lot of upside opportunity. And the seller was a very motivated REIT that is liquidating. They have over 100 assets. And the folks we partnered with in this deal, they basically looked at 100 deals. They selected 6 to bid on. They won 5 bids. We looked at that list and we selected only 2 we wanted to invest into. And that's what we did. So the opportunity, and by the way, the bid was completely non-competitive. So they lowballed and they still won because there was no competition. Non-competitive environment is exactly what you want to get into. Location is great. So that distressed REIT sold their best assets to raise the capital to finance the crappy ones. It's a distressed seller situation, but not a distressed asset situation. And the substantial value add, the assets were under managed. For example, Fairfax, Virginia had a great upside to 25% vacancy. Orlando has 10% vacancy that can be filled easily. There are out parcels that can be sold at a much lower cap rate that the deal could be acquired at. And downside protection also comes in the form of a fixed rate debt mortgage with no prepayment penalty. To make the long story short, this is a very attractive deal. We loved it. We invested. If you want to learn more about the deal, please visit templefunding.com/dealsroom and learn more about this. I'll reach out to Diana with any follow-up questions. Let's talk about the biggest pressure point in the economy. And it's coming from the fact that the interest rates have gone from 0 to where they are now in effectively 1 year and maybe 3 months, very short amount of time. And that's created gigantic pressure on many owners that have borrowed with variable rate debt Some of them bought rate cap, some of them didn't buy rate cap, but the rate cap has an expiration. The deals from 2 years ago, some of their rate caps are expiring soon. That's going to create a ton of pressure. When the interest rate reset, the jump is just gigantic. Most of these loans were tied to an index, and then the index offset is 5% difference. So here I'm using an example of rate jumping from 3.5 to 6.5. In reality, many of these deals have jumped the rates to 8.5, even higher. And the consequence of this gigantic pressure point, they can't keep the debt service, even if the value at work has been successful and the rents have gone up 25, 30%. So this disbalance between increases in rents and the debt service is what's creating massive pressure on many owners and operators. Let's just talk a little bit about banks. Banks' experience has been pretty painful. We all know of the 3 banks that effectively fail and be taken over: the Signature Bank, the Silicon Valley Bank, and then the First Republic Bank. And the failures of these banks have created essentially really good news for the big banks. If you want to call it grand conspiracy theory, you could do that. But the big banks really enjoyed the flight of deposits, and then the small banks have suffered greatly. And I call it, honey, I shrunk the deposits, but we have to pay high interest rates on remaining money. So the environment for small and regional banks is very, very painful. Many loans that we're supposed to repay are not repaying because transactions volume is down. So to put it in layman terms, they loan the money. These deals were supposed to be selling this year, refinancing. They can't refinance. They're not selling because transactions just operating on a much lower volume, as I mentioned. So the capital is not coming in. On top of that, some lenders they used lines of credit. The lenders to the lenders, the operators with lines of credit are shrinking their lines of credit too. This is general credit tightening. And as a result, it's a very painful experience for banks. Some loans are beginning to default, and their balance sheets are upside down in the form that they made loans for long. Banks borrow short. Basically, they pay interest on demand deposits. That's their borrowing. And they lend long when they make mortgages or other long-term loans. So they made these long-term loans and the interest rates were low. And now they're collecting on the interest rate less than they're paying on the deposits. So their P&L is upside down, and then their balance sheet is upside down because these loans are worth less because they locked in low interest rates for a long time. So the only way that's keeping the banks afloat, or many banks afloat, is the fact that they can held to maturity. It is an exemption, but it's not a fun picture. So
Can you tell how debt is an opportunity, Mike?
So that is an opportunity from the point of view that if you're a bank and you're holding a loan that's in distress, or it is something that you need liquidity and the loan is performing, it is at a much low interest rates at the time of origination versus now, you have to sell. If you have to sell that loan as an owner, as a bank, to raise cash, as an investor, you can be very opportunistic. You can come in and demand significant discount. You can get a discount on performing loan. You can get a discount on distress and discounted loan. So from that perspective, you can come in and be, I don't want to call it a vulture investor, but an opportunistic investor. And the bank needs to sell, or any owner needs to sell. That's the opportunity for the buyer. That's where, unfortunately, in real estate, one man's problem is another man's opportunity. This is the way of the land. This has been around, and this is how it operates. So that's fresh money has a great opportunity to get distressed and discounted deals. So there are a few different ways this can work. It can come in the form of rescue capital. So when you're an owner of a property and you're in distress and you need equity capital, what options do you have when your debt is maturing? You need to raise fresh capital. So it can come from existing investors in the form of a capital call, or you can go to new providers of capital if your existing investors are not willing or are not able to provide the capital. And you can basically request it. And then the fresh money will come in the form of preferred equity or mezzanine debt, push all of the equity back, and only be subordinate to the primary debt. As the fresh money comes in, it could come in as a rescue capital. There's also a scenario where you can try to extend the current loan with existing bank, and that extend scenario have two primary options. Most of the banks will ask for cash in extension. In other words, you have to raise more capital from investors, just like in the first bullet, to be able to extend the loan with the bank, because the cash in will be required either to buy a fresh rate cap, or to lower LTV, or to provide additional reserves per bank requirement. There are also scenarios where it's going to be extend and pretend. What that simply means is the owner of the property just cannot raise the capital. So the banks will have a hard option: put the loan in a default and start foreclosure, or to give investors a little more time, maybe do forbearance, and work with investors. Let's just call them extend and pretend. Now the option, which is not an ideal option, but that may be the only option if the asset is severely troubled and fresh capital cannot be raised for the deal. Now, let's talk about refinancing. On the refinancing side, if the asset value has been completed and it's been leased up, it's been stabilized, going to agency debt is the primary plan in this environment. As much as possible, most operators go and refinance through Fannie and Freddie, get great long-term debt. Right now, approximately right now, the rate on a Fannie Freddie debt is about 5.5%. Can change over time, but given everything else, where the bridge costs 8.5, 9, even higher, going to Fannie and Freddie is a viable option. Some deals just are very difficult to go to Fannie Freddie yet. They're not fully stabilized. They need fresh debt or fresh bridge debt, and that'll require some more capital, probably cost a lot more money. The last option is to sell the asset through a normal sale when the asset is stabilized, or distress sale as fresh money. That's where the opportunity is. As existing owner, of course, you want to sell as normal non-distress sale. Well, if you want to, you can play the game and blame Federal Reserve. Whether you want to blame them or not, I'm a big fan of studying Federal Reserve. I love to study, understand what they do. They don't have an easy path. So I'm sympathetic, although I do think that they're often late and often wrong. At the same time, they don't have an easy job. These great minds of our age, Jay Powell, Ben Bernanke, Janet Yellen, Greenspan, they were all bright academics, but they're not necessarily great business people. Although Jay Powell did spend years in the big business. It's very difficult to set Fed policy. Honestly, I'm not defending the Fed. In fact, this is all very, very difficult. Central planning is very difficult. That's why capitalism works, and central planning often suffers. But this is one element of capitalism where the bankers actually set the interest rate, the primary gauge of risk. So to make long story short, blame the Fed or not, doesn't matter. They went from 0 interest rate to 5 to 5.25 very, very fast. And that's causing a lot of pain. That's causing a lot of potential problems. And it was too fast and too furious, in a manner of speaking. So let's now talk a little bit about many deals and operators are struggling simply because the deals have been underwritten for perfection. There was lack of reserves. Variable rate debt is a gigantic problem as it's reset. Underperforming value-add projects have created substantial need for additional liquidity to finish. And on top of that, market conditions have changed. Well, things were just running great, and suddenly, fairly quickly, a lot of challenges have hit. And they're only just financial challenges, but they're stress points for many operators. And the worst part about this is not just one deal going bad. A whole bunch of deals, all in parallel, have problems just because the market conditions change, interest rates reset. So it's a market shift that is causing all kinds of stress, and cash is the king in this environment. There are 4 primary scenarios that every investor should go through in their portfolio. And we're not any different. We also go into these scenarios in every investment that we make. So there are some assets that are performing well and no debt maturity. Those are wonderful, they're in great shape, nothing more to discuss. Some assets are performing well, but they have a debt maturity problem or risk. These assets need to be reviewed for debt maturity, and a plan needs to be developed, either for additional capital raise or some kind of scenario where it can be worked out with a bank to give the deal more time. But in general, these deals are worthy additional capital to survive. Of course, every situation is different. Conceptually, well-performing deals with maturing debt should be worth additional capital injection and further work out to get them to the point where they can be sold or refinanced with a greater debt. Third scenario, assets are underperforming, but the debt is fixed rate. And this scenario is worth a discussion too, because this scenario has got good debt, but underperforming asset. More capital can solve the problem. This type of deals need to understand, can the operator solve the problem? Can they actually get the asset to a complete stabilization or a new operator is needed? And if the operator is still solid, they just need more cash, then that capital injection may be worth it. So scenario 2 and 3 are worth serious review and consideration. Scenario 4, the scenario where most likely you have to realize that this is a deal that you're going to have to probably write down, whether you want to do it or not, or when the resources and time is finite, you have to pick and choose your battles. So choosing to focus on the deals that are worth survival and additional capital is where you can succeed doing that. If you're going to allocate resources to the unworthy deal, that may be good money after bad money. So underperforming debt maturity type of deals may not be worth rescuing. Of course, you have to analyze them, but if you come to that conclusion, pick and choose your battles carefully. Opportunities to thrive. So this is the mentality. This is the way to think about in this environment. So you're looking to participate in distressed opportunities where fresh capital comes in, and it's a very opportunistic capital to get strong returns. So you're looking at strong ROI. You're looking for strong downside protection for the fresh money. You're looking for distressed sellers instead of distressed assets. Ideally, you want a high quality asset and a distressed seller. In this day and age, low leverage is the name of the game. So most of the fresh financing is available at a lower leverage as in the past. Depending on the asset class, location, and other variables, what used to be 70% now is 60, what used to be 75 and now is 65, and so on and so forth. Because the LTV requirement requires more conservative underwriting, and two, debt service coverage ratio is obviously harder to meet with high interest rates. Picking your strategy, your markets, your asset types matters even more. And also there are capital accelerator partners. The way I like to put it is strength for numbers. When we look at a deal, we invest with other fund managers, we invest with other folks that write big checks. And as a consequence, we're able to negotiate better terms. So strength for numbers really works in this environment. Fresh capital deployment opportunities, we'll cover this briefly. Where can fresh money go to work? Again, this presentation was all about surviving and thriving. On the thrive side, it's the new opportunities. So we talked about rescue financing only for the worthy projects. Deals have to be underwritten, and worthy projects can either get capital in the form of preferred equity and mezzanine debt. There could also be discounted new acquisitions, essentially fresh financing for equity on the new deals, either preferred or common. And then the last scenario could be acquisition of distressed debt, primary or mezzanine debt. As Diana, you mentioned, you asked the question previously. There are deals where you can acquire from the bank distressed debt and then work with the operator to take control of the property. If the debt is at the conservative LTV, you can invest with strong downside protection through the debt position and have the upside if you can work out a good deal with the operator, either deed in lieu or you can work out some other terms. So this is a capital stack picture here on the right, just talks a little bit about capital stack. And then the investing with downside protection, you have to look at a few elements. Number one, who you're investing with, who is the operator? The integrity, the ability to solve problems, the ability to execute. What kind of strategy? Are they buying at a discount or are they building new? One key point, there's still folks raising capital for ground up construction deals. And I have nothing to say negative about that. That's their business. Unfortunately, from my view, you cannot get discount on construction or labor. Basically, it costs what it costs. Inflation has actually been making it more and more expensive, although things have stabilized. But it's difficult to get a discount on new construction. You can get a discount on land, but the building still costs money to build. With existing structure, you can get substantial discount. If it's a motivated seller, you can get a great deal, and that's where the big opportunity is. Obviously, capital structure, you're investing in mezzanine debt, preferred equity or common equity, understanding the risk, who's behind you, who's ahead of you on the capital stack makes all the difference. What kind of market are you investing into, cyclical, non-cyclical? Is the market likely to correct? Well, this is a steady Eddie market. And obviously deal fundamentals make sense. So all that is important to be able to establish downside protection. Think like Warren Buffett, like Oracle of Omaha. Best example is to see what the Warren Buffett has done in 2008. Sitting on a lot of cash, and when the market was in severe distress, a lot of concerns, even for surviving of the top US investment bank, Goldman Sachs. There was a lot of fear. And at that time, Warren Buffett was greedy. His expression, be fearful when others are greedy and be greedy when others are fearful. He was very greedy when others were fearful. He wrote a big check, $5 billion check in preferred equity of Goldman Sachs. Which was ahead of the common equity, created downside protection, gave him strong dividend yield, prepayment penalty in the form of special dividend, and on top of that, phenomenal upside in the form of $5 billion worth of warrants or options on a common stock. And then there were a number of other restrictions, like executives of Goldman Sachs were not allowed to sell their stock until Warren Buffett got repaid in full. So that's the philosophy. That's the way to think when you come in and you can negotiate terms and get into great partners. One of the key elements here, you don't want to write a check with great terms to an idiot. Warren Buffett started with a great company. He says, you would rather invest in a wonderful company and pay a fair price than invest in a fair company and getting a wonderful price. That philosophy really applies here. He chose In this situation, he got both a wonderful company and a wonderful price. That's the way to think. This is how you thrive during an economic downturn. So how do you prepare for opportunities during recession? Number one, you can get to know opportunistic funds that invest in distressed and discounted deals or some operators, and then look at the direct opportunities and syndications. You can do due diligence before writing a check. With funds, typically you have the opportunity to do the due diligence and investigate the funds and pledge capital now and deploy the capital when the deals are ready to be funded. So you get to know, like, and trust the fund managers and operators, do the underwriting, look at the existing portfolio of the fund, look at what they're going to likely invest in the future, how things are structured. All that is important. And then diversification, can't stress enough. We'll talk about that on the next couple of slides. Diversification matters now even more than during the days of the hot market, because in this type of environment, some things may go under. Without good diversification, you're taking in too much risk. Diversification is absolutely great for risk mitigation, lower volatility, high predictability. In your capital allocation plan, where the fresh dollars are going to go, if you don't have a plan, you're going to see bright, shiny objects, and you're going to act on that without a plan. It's not a good strategy. Let's talk a little bit about the riches and the niches. There is a high yield in this environment of difficult yield. The yield on equity on many deals is just hard because interest rates have gone up. We have a wonderful strategy in Tempo Income Fund where investors that participate in Class D1 and D4 units, they receive annual distributions of preferred return paid quarterly, 12 to 15% per year. Great yield. And the strategy is very specific. We have a great partner who we work with. We loan money to them at the interest rate between 16 and 18%. What they do with money is they buy non-city land, basically, typically land outside of big cities, not infill, more like a rural recreational land outside of big cities. And what is recreational land? So recreational land typically used for running dirt bikes, for erecting camping grounds, for shooting personal guns. So recreational land has plenty of uses, and folks buy these lots, and they buy them at a great cheap price, for example, $4,000 a lot, and then they market it through their website, and then they sell it at $20,000, $25,000 price, many times, many X, 5, 6X, and they sell it as $300 down, $300 a month. So it's basically very, very powerful strategy. Folks that don't pay, they lose the land contract, it gets sold on a land contract, and there's no foreclosure. So this strategy is incredibly powerful. Most folks stick with these type of payments. They're affordable. And by the way, high interest rates make no impact on this. The fact that the interest rates have gone up makes no difference because they sell these land lots not on interest rates, but they sell them on a payment plan. Just a couple of words about Tempo family of funds. Diana, would you be so kind as to step in and talk a little bit about each of our funds?
Sure. Tempo Income Fund is open-ended, which means you can come in quarterly. There is also quarterly distributions. It's income focused. So every asset within the fund is to get you that return, which is targeted between 8 to 15% annually. There is 2 strategies within the fund. And Class D is what we were discussing on the last slide, where they have the land lots across the United States that give you a stable, predictable return. Class A, B, and C are doing really great right now, and they are a diversified portfolio of assets that have open air shopping centers and industrial, as well as hard money loans. Tempo Opportunity Fund is our flagship fund with over 50 different assets. It is also an open-ended fund with income and growth focus. There's a lot of different assets in there, as mentioned, and their target returns are 10 to 13% annually. Tempo Growth Fund 2 is a closed-ended fund, which will be 5 to 7 years long. The closing for new subscriptions ends February 2024. It is targeted between 13 to 20% annually once those distributions start from sales and refinancing events. We hope that the distributions will start in 2025.
Thank you, Diana. Thank you for clarification. And yeah, appreciate your commentary. We are obviously income focused in this environment, and for both Tempo Income Fund, Tempo Opportunity. Tempo Opportunity is one quick comment. It's about 3/4 income, 1/4 growth. So it does have a little bit of a growth element. Well, in real estate, there's 3 words: location, location, location. But there's also 3 words called diversify, diversify, diversify. It's critical that folks think about this. as the priority number one. Can't stress this enough. It's ahead of everything else because you don't know what's going to be a home run, what's going to be a strikeout. So diversifying across many dimensions of diversification is what we do. Many property types, as we talked about, multifamily storage, open air retail, and so on and so forth. Different locations around the country, different operators, different strategies, debt and income. That's what diversified funds do. And one of the most important benefits of diversification is risk mitigation, reduction of volatility, and creation of higher predictability. That's the reason diversification is vitally important.
That pie chart was actually showing the diversification in Tempo Opportunity Fund.
Yeah, I appreciate that. It's a snapshot of in time, but that's what we try to do. We try to spread the risk among many strategies, different regions around the country. And then downside protection. So how do you invest with good downside protection and strong upside? As I mentioned, number one priority in this approach is prudent diversification. Number two, investing with people who you know, like, and trust in what you understand. No bright and shiny objects, more of understanding really well what these assets are, making sure that something that you invest in fits into your overall strategy. And obviously conservative underwritten deals with asymmetric returns, well understood downside, and then strong upside and adjustment for risk, especially in this environment. Well, it's probably one of my favorite slides. People are asking for the crystal ball. They've talked about future statements, and a full disclaimer, nobody knows the future. So my wonderful crystal ball broke. I can't find another one for sale. I'm looking for it. If you know it, please reach out. Happy to look at it. But majority of us just don't know the future. Predictions are another waste of time. It's just a very difficult trade. And those who predict, if folks got paid how they predicted, most people would be broke. Unfortunately, predictions are very, very hard. Nobody really knows the future. You have to know yourself, your portfolio goals, and your own portfolio. Be prepared to act when you see great opportunities and invest with people who you know, like, and trust in what you understand, and avoid bright and shiny objects. That's about it. Appreciate everyone's time and attention. If you'd like to learn more about us, Yana, would you be so kind to tell folks how they can reach out and request more information?
Sure. Our website has a lot of information about our funds where you can view all of the details and compare them. But if you have any questions that are not answered, please reach out to us at invest@tempofunding.com. You can also schedule a call with me, and I will go over any questions you have in depth. My email is deanna@tempofunding.com. And to schedule a call, it's tempofunding.com/IR call.
Thank you kindly. Thank you all very much. Have a wonderful day.